Now let's keep the ball rolling on those 2011 predictions. You've heard a lot of them in the last couple of weeks. Our next guest was correct in 2010. His forecast rated at best at Bloomberg. So what's next? We have Mike Englund from Action Economics. Mike, good to have you with us on Bloomberg Taking Stock.
It's my pleasure to be here.
All right, so take a look at GDP. You just heard what Julie Hyman was talking about in terms of Byron Wien saying that it's 5% growth for GDP in 2011. How positive are you on economic growth this year?
We know we have an outlook overall that's very similar to the one you just described, but when it comes to GDP and the unemployment rate, we're a little less optimistic than some of the high shooters that you've seen in the market over the last week or two. We are looking for GDP growth to accelerate early in the year because of the payroll tax cut, which is going to kick in right away in January, and we think that's going to push GDP growth up toward 4%. I'm not sure we're going to make it to 5%. And we do think the unemployment rate will be falling through the year, but we're assuming we're still going to end around 9%. One big headwind for the unemployment rate is that as the labor market tightens, the labor force is going to start to grow faster. It was really quite weak through this last cycle. A lot of people moved out of the labor force. They're going to jump back in. So I think it's going to be hard to get either the GDP numbers up toward 5% or the unemployment rate below 9%, I think, before at least the end of this year.
All right, so just to define that unemployment number we were just showing, for example, remember that famous scene where Babe Ruth, points and says where he's going to hit the home run. You're pointing ahead to 2011. Telling us what's going to happen to unemployment. What kind of unemployment rate do you expect, let's say, at the third and fourth quarters of 2011?
Well, we are assuming we're going to approach 9% right around the end of the year, and once we get to that point, we'll be dropping about 0.2 a quarter throughout this coming expansion. Most expansions show a similar decline in the unemployment rate at that pace. The wild card will be the labor force, and we'll have to see, and in fact, this Friday will be interesting. Once a year, they do annual revisions with the household data, and it'll be interesting to see on Friday, how the unemployment rate enters 2011. Our guess is going to be that there's going to be an upward bias to the unemployment rate early in the year. We may get some upside surprises. In the second half of the year, that's when we should start to see the unemployment rate tick down.
Mike, what about interest rates? What are you expecting, let's say, for the 10-year Treasury bond?
We are looking for a steady climb in 10-year yields. As you note, they were around 3.4% now. We are looking for a climb above 4% by the end of this year, probably up toward 5% at some point in 2012. So we have a similarly pessimistic outlook in the Treasury market. I think the Fed's QE2 program probably had a positive announcement effect last August, September when the program was being discussed. But going into November and December, the market's really given back much of that. I think the Treasury market's unlikely to benefit from this program going forward. When the Fed ends the program in June, I think you're going to see those 10-year yields and other yields in the marketplace rise with it.
All right, Mike, you talked about unemployment. We talked a little bit about GDP and Treasury yields rising. Tell me about oil prices. Where do you think oil prices are headed? We're above $90 a barrel, like $91, $92 a barrel for oil right now.
Yeah, well, we're certainly in the camp that's looking for oil prices to break through $100 this year. Generally, the peak in oil prices is with the summer driving season around July. Given the momentum in the market over the last couple of weeks, we're probably going to pierce $100 before we get there. Our general assumption in forecasting commodity prices is that they're driven by global growth, not U.S. growth. The world economy grew 4.8% last year. It looks to do similar growth this year. And if you look at the correlation between oil prices and world GDP, that implies about 15 to 20% growth in oil prices. So we think fundamentals are really going to drive all commodity prices higher, and oil is probably the most visible one of them.
All right, so Mike, every time we take a look at those oil inventory numbers issued by the Department of Energy, that kind of makes traders and investors go crazy. You're saying, okay, you can pay attention to that, but what you really want for price indication is you want to look overseas, want to see how much other people are using oil.
Well, exactly. And if you look at a 20 or 30-year graph, you'd be surprised at how correlated they are. Of course, oil prices are very difficult to predict and are quite volatile week to week, so it's a dangerous game forecasting oil prices. But if you look at that 20-year pattern, about 3 out of 4 years, you can predict the direction and the rough magnitude of the oil price swing just from world GDP. This is going to be a strong year. China's economy is growing well, so is India. Most of the world economies are in a growth phase right now, even though the U.S. is underperforming what most people would like.
All right, so what about inflation? I mean, you were listening earlier with Julie Hyman. She was describing Byron Wien's outlook for agricultural commodities. You're telling us that oil might be $115 a barrel. That certainly sounds like inflation, at least to most people's ears, but not to the government.
Well, one dichotomy among economists is that some tend to focus on core inflation, some tend to focus on headline inflation. I prefer headline inflation. Headline inflation are the prices people actually pay. Food and energy prices, which are excluded from core, are the ones that are the most visible to households and businesses. And as you know, commodity prices are rising. Most people think they're in a rising price environment now. The Fed is focused on deflation risk. And if you look at core inflation, it is a function of capacity utilization. And as long as we have a high unemployment rate, those core inflation numbers will probably stay low, signaling to the Fed no inflation problem. But to a household that have to buy food and energy, obviously as prices continue to climb, they're actually focused on rising prices rather than the low core numbers.
All right, so if you're focused on those headline numbers as well, what is the outlook, let's say, for the U.S. dollar? Are we going to see the value of the dollar continue to erode? Because that seems to be that inverse relationship to the increased price of commodities.
Well, yeah, we do look for a downward tilt to the dollar through 2011. Ironically, one of the adverse effects of the Fed's quantitative easing program is that globally the Fed's cycle is out of phase with the other central banks, and the result is that the dollar is declining. With that decline in the dollar, what we're seeing is rising headline inflation numbers as the public has to pay more for food and energy. Yet the confidence effect is probably depressing some of the economic variables that drive the core inflation numbers. So ironically, even though we're unlikely to see much recovery in core inflation this year, and perhaps some uncertainty is feeding that decline in core inflation, the headline numbers are probably going to gain steam because of dollar declines.
Mike, what about consumer confidence? When we take a look at the University of Michigan survey as well as the Conference Board survey, they seem to be giving us contradictory signals. Now, we're going to see a decrease in that FICA deduction in most people's paychecks beginning in January. Is that going to make people feel better about the economy?
Oh, we think so. We're actually looking for retail sales gains of 1% in both January and February, and we do expect some updraft in the confidence numbers. If you step back and look beyond just the December swings, you'll see most of those confidence numbers have climbed in the fourth quarter back to almost where they were in the second quarter of last year. We had a little summer lull, and I think some of that updraft is already reflecting the fact that people are looking for tax relief into January, but a lot of people are going to have to actually see it in their paychecks. And I think some of those stronger sales numbers hitting the news wires for the next couple of months will probably make the economy look better, though you have to keep in mind that when we get to the end of 2011, those tax cuts are all going to be reversed in January of 2012. A lot of the news stories will focus on that. So we've kind of got about a 6 to 9 month updraft in the spending numbers from those tax cuts.
All right. Well, if you take a look at those tax cuts and the stimulus programs, does this mean that GDP might even surprise you on the upside? What would it take to get you to lift your predictions for U.S. growth?
There's a gap between sales and output. We are looking for stronger sales numbers into 2011, largely from these payroll tax cuts. Whether or not that comes out of inventory or whether factories actually gear up and produce more is a different matter. Industrial production, strangely enough, has actually slowed in the fourth quarter to about a 2% clip. We are looking for a bounce in the first quarter, but how strong that bounce is, how much the ISM-related indicators continue to firm into January and February, will probably tell us how much producers are actually pre-producing in anticipation of these sales versus whether it was simply going to sell out of inventory or import those goods.
Mike, what about the housing industry? Do you see any prospects for a rebound in housing? What about the inventory overhang?
Well, we actually got great news today from the construction spending report on housing. With each monthly construction spending report, they've revised down both the residential and non-residential construction numbers. It's been a pretty ugly cycle. But the last 2 months, they've actually revised the numbers up. With hindsight, it looks like construction hit its bottom in August of last year. And it looks like we're going to have a pretty good close into the year. December may be disrupted by bad weather, but we think by the first quarter, both residential and non-residential construction should be posting positive growth. Right now, we peg it at about 5%. So actually, I think the housing turn in 2011 may be really captured by the media as a driver, even though housing is actually a small part of the economy. We hardly look for a strong recovery. 5 to 10% growth in that sector is not very strong for the housing sector, even though it sounds better than the negative numbers we've had for the last 3 years.
All right. I want to thank you very much. Mike Englund joining us from Action Economics, a Bloomberg best in 2010. We'll see what happens in 2011.